So Christian and I are here to dispel some myths about buying your first home. And while we were at this doing research for the show, we came across a couple other myths that we think we should dispel before we go into it. So Christian, let's take turns going back and forth. First off, swallowing a watermelon seed will cause it to grow in your stomach. This turned out to be false.
That one shocked me. My mom was convinced on that one. At least that's what she told me.
Yeah, bro, I don't know how to explain my stomach if it's not a watermelon growing.
Yeah, there you go. How about, the one that always bothered me? How about waiting 45 minutes after you eat to swim? I always wanted to jump right in the pool after dinner, man.
Pure manipulation turned out to not be true. Another one, if you swallow gum, it takes 7 years before it is digested.
That's a good one. I feel like the problem with that is all the gum ended up on the school tables underneath.
Because everyone was afraid of swallowing.
Everybody was afraid of digesting their gum. That's right. That one had a negative side effect on society. How about step on a crack and break your mother's back?
That was indeed false. We actually collaborated with Maury Povich on that, and a lie detector test proved that that was not true. Cracking your knuckles does not get you arthritis. Another myth busted.
How about the 5-second rule? All right, drop food, pick it up real quick. No bugs can get to it.
Completely man-made and manufactured.
I like that one, though. I've saved a couple good cookies with the 5-second rule.
Another form of control busted here at Mortgage Mondays on BiggerPockets. So on today's episode, Christian Batchelor and I are going to be debunking many of the myths that go into buying a house to get you prepared to get your first home in 2024. But take a second before we jump into it and let us know, what is a myth that you always believed that turned out to be false? Drop it in the comments. We're going to cover it in a future show. Let's get into it. Christian, welcome to the show.
Excited to be here. Another fun topic today for y'all.
All right, we're going to do our very best to make this like a frequently asked questions myth buster. So from my perspective, one of the first things that I always hear people say when they want to get a house is, I need to get my credit score higher. Now, I hear this all the time, but those of us that actually work in mortgages know it's really not a significant impact on your overall ability to borrow money and on your interest rate. Can you explain the tier system of credit scores and how you as a professional mortgage broker think that people should look at their credit score when waiting to buy a house?
Yeah, absolutely. Especially in this bucket that we're talking about as first-time homebuyers, which is usually primary residence borrowers. There's really a lot of options for low credit. I mean, the FHA loan will go down to like a 500 credit score. It's wild. Usually people will hear, I have a 600, I can't buy a house. That's not true. There's a lot of misinformation. Now, when you get into investor type loans, obviously there's more criteria there. The scales are really tipped in first time homebuyers' favors regarding credit. And for the tier system, David, there's like 6 brackets of credit. Like that's it. Below 600, 6 to 620 to 640 to 660, every iteration of 20 points. And there's not a difference between like a lot of people think, oh, I have an 800 credit score. Oh, and then I, got a car loan and it went to 740. You're in the same pricing bracket. Usually anything above 720 or 740, like you get the same pricing no matter what. You're just deemed to have good credit, right? So some people think like that, oh, I want to get over 800. I mean, it's bragging rights, but you're not getting anything from that. You're going to get the same exact loan offer as somebody with 740.
Yeah, I think people assume if I can get my credit score higher, their rate's going to be like half a point less if they can bump it up 10 to 15 points or so. Just give us like a basic ballpark of if you're able to bump your credit score up by X, you can expect to get a better rate of Y.
Yeah, so I mean, if you're at like 701, you need to bump it by 20 points to get to the next bracket, right? You need to get to 720. If you're at like 701 and getting to 710, there's nothing. You're literally not going to have any betterment. You don't get a pricing betterment until you reach the next bucket of 20. Now, if we pull your credit and you come back at 699, we're going to get you up 1 point. Pay your MasterCard down by $20 and you get a 1 point increase, right? And we do that all the time. We have credit rescore systems in our, when we qualify people. But typically, I mean, every bracket of 20, you may get a marginal savings on the rate, but unless you're moving from like a 660 to a 740, which like you would need some pretty massive credit overhaul to do it, there's not going to be like thousands and thousands and thousands of savings. The small fine tune adjustments are great, but unless you're really moving, like unless you're getting collection removed or something like that, that's where you see the really big changes. But really otherwise, the fine tuning will get you, save you a few $100 here and there. But like David said, credit is much more malleable than you think it is.
Moving on, let's talk about debt to income calculations. How do lenders determine how much someone can borrow on a loan?
A debt to income takes really everything into account. It's really what shows up on your tax returns. A lot of people think I don't have a W-2, so I can't get a conventional loan. It's not true. Debt to income is all debts and all income, right? So if you're self-employed, if you own real estate, if you have 2 jobs, whatever your income is generated from, there is a rule to underwrite it. Now, you may go to a bank and the bank says, we don't do self-employed loans. It's possible. They have the right to choose to not do those, but it doesn't mean you can't get it. right? There are absolutely conventional loans no matter what your income is sourced for. And some income has, averaging rules and yada, yada. But the rule of thumb really is if you have income, we can use it. And whatever your debts are, another common misconception, I have credit card debt, I can't get a mortgage. I have $20,000 on my Amex. Well, if your monthly payment is $300, we're only hitting you with $300, right? We hit you with the monthly payment, not the balance. So I've seen people with tens of thousands of dollars on credit card bills, and they still qualify for a conventional mortgage because we're hitting them with the few $100 a month they have in payment, and they make enough income to compensate for it.
Okay, so what's your overall advice for somebody who's worried about their debt to income ratio? What's a healthy amount of debt that people should have? And is there some debt that is worse than others?
My overall guidance is you need to talk to a loan officer. That's the ultimate cheat code, right? Don't try to calculate your own debt to income ratio. I've literally had some clients send me a spreadsheet. Here's my income. Here's my side hustle. Here's my real estate portfolio. Here's my debt to income. And they're not even close. Don't try to calculate yourself. There are mortgage professionals that are literally trained and guided to do this the correct way. So number one, talk to somebody so that you can actually get a depiction of what you need to do. And in the event your debt to income is too high, talk to them about which liability is good to pay off first. Should I pay off my car first or my credit cards? The answer may surprise you, right? It's not always just your high interest rate credit card first. It may be the car, right? If they're similar balance. So talk to somebody, get the advice and guidance. And for your last part of your question, is there some debt that's better than others? Any debt that leads to generating income is always going to be best. So obviously the most logical purpose of that is real estate mortgage, right? Oh, I don't qualify because I have a mortgage. Well, no, if that property is generating rental income, I can use that rental income to offset the mortgage. And many times a property cash flows, so it generates more income than it expenses, which means it actually increases your borrowing potential, right? It doesn't hurt you to have that mortgage. It helps you because it adds more income to your file as compared to the debt.
Let's talk about when you have a W-2 job versus you're self-employed or you get paid on a 1099. When we say 1099, you may hear this in the BiggerPockets ecosystem. Basically, this means somebody else is sending you money. They're paying you for contracted services, and then you get a form called a 1099, which is them telling the IRS, I paid Christian this much money, so tax him for it instead of me. So basically, it's a way of saying that this company maybe that I own made money, but then I paid that money to somebody else. So that should be on their income taxes, not on mine. So for those that get paid through a 1099, this could be a small business owner. This could be somebody that's contracted to work for somebody else, like a real estate agent that works on commissions. Anyone that's not getting that standard W-2 salary, how is getting a loan different for them?
It is different. But just like I said earlier, it does not make you incapable of getting a conventional mortgage. You can absolutely qualify for standard mortgages as a 1099, or as we call it, a self-employed individual. There is a difference in the way that we calculate your income because obviously you don't have salary. So typically we take a 1 or 2 year average. Regardless of how it's calculated, the answer remains the same. You can get a conventional loan if you're self-employed. You just need to talk to a loan officer that knows how to do them.
Okay, there you go. So when you're applying to get the loan, you should say to your loan officer, do you have any experience working with self-employed individuals? Because it is a very different process than they may be used to if they've just been doing standard W-2 loans.
100%. Absolutely.
Okay, let's move on to down payments. How much do I need if I want to put a down payment on a house that I want to live in?
Yeah, I mean, if you ask, unfortunately, probably 50% of the population in America, they'll all say 20%. That is a myth. That is not true. You do not need 20% to buy your first home. If you're occupying it, you can buy it as little, VA 0% down, but for a loan for the everyday American, 3% will get you in a house. 3%. Take your purchase price, multiply it by 3%. That's what you need in your bank account. That's it, right? Which is such a supreme misunderstanding that somehow it's become the norm to assume you need 20. And that's why people say, I'll never be able to own real estate. I can't save up $100,000. You don't need to. 3% will get you in a house.
So where does the 20% number come from?
For investment properties, that is where you start. So when you start building a portfolio, investors need to put 20% down. That's absolutely true. But as David said, we've talked about it so much on this show and just in the BiggerPockets community in general. You can buy one house a year as a primary residence. 3% down every year. Buy one house a year and just keep doing it. Right. And there's ways to structure it where you qualify and making sure that you're upgrading and all these things. Talk to a loan officer once again, but you do not have to put 20% down, and you can build a portfolio of 20 homes over 20 years, never putting 20% down.
So I do agree with you. 20% is the down payment on investment property, something you don't plan on living in versus a primary residence. I also think it could have gotten mixed up because when you put 20% down on a house, you avoid PMI.
Yeah.
And so people don't like PMI. It obviously makes your mortgage higher, which is a good segue. Let's talk about that. What is PMI? What does it stand for? How expensive is it? And how do you avoid it?
Private mortgage insurance. This is the fee that you pay. Basically, just consider it a tax. You're getting charged for putting less than 20% down because your leverage is deemed too risky for a lender to just hands off give you a mortgage. PMI is usually this like boogeyman. A lot of people want to avoid it. Oh no, I don't want to pay PMI. When you really break down the numbers, I firmly believe that probably 80% of listeners, so all you guys listen to this right now, you would be shocked at how low your PMI is. In the last 5 years in the industry, it has dropped so much. I used to see PMI 700, 800, 900, $1,000 a month on some high value properties. I mean, I'm in California, so you can cater that to wherever you are. They used to be such large portions of your mortgage. Now I regularly see PMIs $30, $70, $150. Like it's supremely affordable now, right? Especially for people who are considering the alternative of saving 20% down. I'd pay $100 a month to not have to bring $100,000 to the closing table. I think you'd agree, David, right? I mean, it's like, it's such a trade-off that's not in proportion. PMI is not the boogeyman.
In my day, maybe like 6-7 years ago, when we were selling tons of houses, we would get people that would say, I don't want to buy a house because I'm saving up enough so I can avoid PMI. And they were trying to save like $150 a month. And by the time they could save the difference between 5% down and 20% down, the house had appreciated by $75,000 to $125,000. And it was way more than the $125,000 they thought they were going to save. Plus, they missed out on 6 figures of equity. And I learned the hard way, especially when we're printing money like this and real estate values are going up to the degree they are. You're better off to buy the house, pay the PMI, and refinance out of the PMI once you get to 80% loan to value. Now, what about down payment assistance? I see this all the time. Loan officers advertising on their Facebook pages, on flyers. We have down payment assistance available. What is down payment assistance? Is it actually free money or does it come with a cost? And why do so many loan officers advertise this?
I don't love down payment assistance. Now, I may get roasted for saying this, but I don't believe that down payment assistance puts borrowers in the best position very often. I think more times than not, it's not in the best interest of the buyer. And the offset of just putting 3 to 5% down far outweighs the cons from it. How they're normally structured is down payment assistance is either usually a second loan at a higher interest rate. So like, let's just say you put a 5% down payment assistance, you get a 95% first mortgage. The lender will give you that 5% second mortgage and it'll be, 2 or 3% higher interest rate. And you're now 100% leveraged. And if that property drops in value, you're immediately underwater, right? There's absolutely no wiggle room. You pay that loan off a little slower because the interest rate's higher. It's just not in the best interest. Another way they're structured is an appreciation share, which means you don't have a payment on that 5%, but the lender always keeps it and gets a little piece of your appreciation as the house increases in value. And that goes against what I believe in real estate ownership. I believe in paying down debt, not giving your lender a larger and larger share outside of like the rare niche scenarios of like a reverse mortgage. If you're buying a house, you should be building equity. Your lender should not be building equity, right? That's not the goal. And that's usually how down payment assistance is structured. Now there's some super niche like state and county grant programs where it's forgivable if you live in the house for 10 years. But if any of us can honestly predict where we're going to be in 10 years, you're probably lying to yourself. Like, I have no idea where I'm going to be in 10 years. It's very hard to honestly say you're going to live in the same place for 10 years. So they're tough. They are available. To answer the second part of your question, David, why loan officers market them so much. They're easy to market. It's easy to tell people you can buy real estate with no money down. That's why seller financing is so common right now. It's easy to sell and everybody wants to buy real estate for free. It's just, are you usually putting yourself in the best position by doing it? Same thing I would say with seller financing is subject to. Usually not. There's usually some con coming with it.
So for somebody who is interested in these, what are some of the first questions that they should ask a loan officer that's talking about down payment assistance programs?
They should ask how they're structured, right? Is it a super high interest rate second? Is it an appreciation share where I never get that equity in my house? Is there some forgivable nature to it where if I live in the property for X years, or I've seen some of them, don't miss a mortgage payment for 3 years. Okay. I mean, that's kind of the best one that I've seen. Just don't be late on your mortgage, right? And it gets forgiven, right? The best one and the one that I can get behind the most is the government grant programs. There's a lot, California has like the Dreamers program.
To the buyer, you don't know if it's a grant or if it's something else. A lot of the time it's a catch that a lender is putting together because they need some way to get the phone to ring. They need some way to get you into their landing page. And then when they bring you in, then it's a bait and switch. Oh, you don't qualify for this, but we have this other one that we can get you in. And they're trying to get you as a client. And in my experience, the people that are the best at what they do don't really rely on those gimmicky type things. That's when you're an inexperienced loan officer, you're not good at business, you don't have any repeat business from years of doing a good job, that you have to say like, what's the cheat code? How do I get the phone to ring instead of how do I become really good and get people to come back? So we just want you to be aware of that. If this is going to be your first house you're looking to buy, there are some possible things to look into when it comes to down payment assistance, but I like that. Is this a grant? If it's a grant, where's the money coming from? And then what are the catches associated with it? And you're looking to avoid, that's a good question. I'm going to have to go talk to my broker about that.
Yeah, red flag number one for sure.
All right, let's talk about closing costs, because people do know they need to save up for a down payment, but there's other fees associated with buying a house, other costs associated with owning property that doesn't get talked about a lot because it's not fun and it's not sexy. And closing costs is one of those. How much should a buyer expect to be bringing to closing in addition to their down payment?
Usually 1% to 3% is a fair estimate. What I would recommend for this portion, guys, go back a few episodes of Mortgage Monday. We had a closing cost breakdown video. We walked through a loan estimate. We talked about all the specific closing costs that can happen. 1% to 3% is like the industry standard where we just tell you to be ready for. But if you look at that episode, we went through line by line of an actual loan estimate and really, really nitpicky detail. If you guys are curious about a sample closing and what the closing costs could potentially look like, go check that out. There's a really good breakdown of it.
And you say 1% to 3%, you're talking about of the purchase price of the home.
Of the purchase price, correct.
There we go. Okay. And what are the typical things that make up these closing costs?
Title escrow fees, right? There is a company that is dedicated towards putting the new loan and the new deed in your name. That's title and escrow. They navigate the notary signing, all that stuff. Obviously, the lender fees, right? You could pay points and buy down your rate. We've talked about that a lot on Mortgage Mondays. Appraisal, right? You got to pay for an appraisal when you buy a property. And then usually what's the largest section is your impound accounts. That's your taxes and your insurance. You need to pre-fund an impound account to make sure there's enough money in there to pay your taxes and your homeowner's insurance. That can add up to people, especially, we operate nationwide, but I'm thinking of states in like Texas and California where property taxes are high. Your property taxes could be the largest line item on your closing costs, and that's not really even a closing cost. It's your property taxes. You got to be on the lookout, right? You got to watch out for those things.
All right. And then lastly, there are fees associated with owning a home that are not associated with the purchase of it, but the ownership, the maintenance, and the management of it. So let's talk about those. What do people need to expect to be paying when they're moving from being a renter into a homeowner?
By far the most overlooked part of owning a home, right? It's the after closing costs, right? It's not the cost that show up on your loan estimate. It's not the cost that you talk about with your realtor. It's none of that. It's, what is the couch cost that you put in the house, right? What are your beds cost? Especially for first time home buyers moving from, a rental and apartment, like you probably don't have a lot of stuff to furnish your house, right? Probably need a new fridge. Probably need a new washer dryer. Probably need to do some lawn maintenance, right? Get a landscaper, get a pool guy. Those are all things that they don't show up on a document when you're walking through properties. They don't show up on your realtor's contract. They don't show up on your first quote from your loan officer. But those are things that should be discussed, right? Whether it's you buying with your partner, you buying alone, whoever it is, you need to, maybe reach out to a couple pool guys. What do you charge? $150 a month. Oh man, I didn't really have that in my budget. Good. Now you do. Maybe you need to drop your purchase price a little bit to compensate for that $150 you got to spend on your pool. Those do not overlook those.
Now, what about monthly fees like utilities, the water, trash, sewer? I mean, how many of those are associated with owning a home that people don't think about?
And a lot of those have a deposit. I was shocked, Dave, when we bought in the Smoky Mountains, I think it was the gas, our propane service, because there's no, gas lines up there. Everything's on propane tanks. They make you pay a deposit to get a propane service up to the cabin. And I'm like, what do you mean a deposit? And the deposit was big. We got the property that David and I own, like there's a huge fuel tank out in the front yard. I think we had to put a $1,200 deposit down. That's a lot of money for a deposit for a gas service. That seems insane, right? But those are things that if I overlooked and we were within $1,200 of a make or break deal, that would have broken the deal, right? So you need to be looking out for sure.
So you're going to have water, you're going to have sewer. You're going to have energy. That one's really expensive. It can be electric and gas. That's two different kinds. You're going to have maintenance on the home when the roof goes out, when appliances break, landscaping fees that are associated with keeping your house in good condition. You're going to have to repaint it at times. The dry rot that you get, you're going to have to fix. You're going to have cable. You're going to have internet. There are going to be costs associated with homeownership that are not specific to the mortgage. All right, Christian, let's wrap this thing up. What's a piece of advice that you think everyone should know when they're going to get their first home that nobody tells them?
Have your realtor negotiate seller credits in your deal. It'll get a lower interest rate. It'll keep money in your pocket that you can use for your $1,200 propane deposit. It makes or breaks deals. I literally look at people who get 3% seller credit, and I see the difference in their rates, and I see the difference in their monthly payment savings. It makes or breaks investments.
All right, Christian, thank you for joining me. This has been really good stuff. We want you to own a home. You want to own a home. This is a match made in heaven, but owning a home costs money. So make sure that you're saving that money. Make sure you're making that money. Make sure that you're budgeting that money, and make sure that you walk into buying your house fully prepared for what it takes to do so. And remember, BiggerPockets has resources to help you do that. You can find an agent on there like me. I'm on the agent finder. You can find a lender on there like Christian and I. We are on the lender finder, and you can find a property manager on there. All the pieces that you need, BiggerPockets has. So check that out. Now, make sure you do your due diligence when you're interviewing these people. Don't just pick someone because they were there, but you can get started building your core four through the help of BiggerPockets. Let us know in the comments as you listen to today's show, what's something that we talked about that you had never been told before or you did not know when it comes to buying your first house. Also, remember to like and subscribe in addition to commenting on the video. All right, everyone, that's what we got. If you've got a second, check out another BiggerPockets video. And if not, you'll see us next week on Mortgage Monday.